Have you ever wondered why legendary traders like Peter Brandt can spot winning setups that 99% of traders completely miss, even when they're looking at the exact same chart? The difference isn't just experience or luck, it's about understanding the hidden psychological warfare happening beneath every price movement in silver, a market that's notorious for destroying even seasoned traders. In the next 15 minutes, I'll reveal the advanced pattern recognition secrets that separate the 1% from everyone else, including the psychological trap that kills 90% of silver trades before they even begin, and the hidden market dynamics that legendary traders use to predict moves before they happen. This isn't basic technical analysis. This is the deep psychology that turns ordinary traders into market wizards. The psychology behind silver's legendary reputation. Silver isn't just another commodity, it's a psychological battlefield where emotions run higher than almost any other market. Peter Brandt himself admits that silver is a market that loves to disappoint, yet he still doubled down to 100% allocation. This paradox reveals something crucial about advanced trading psychology. The best traders don't avoid volatile, emotionally charged markets. They exploit them. The reason silver destroys so many traders isn't because it's unpredictable. It's because it amplifies every psychological weakness traders have. Fear, greed, FOMO, and loss aversion get magnified in silver because of its dual nature as both a monetary and industrial metal. When you understand this, and you realize that reading silver charts isn't just about technical patterns, it's about reading human behavior at scale. What makes legendary traders different is their ability to recognize when the market is displaying collective emotional extremes. They don't just see a diamond pattern breaking out, they see the psychological story behind why that pattern formed in the first place. The diamond pattern itself represents a period of collective indecision where bulls and bears are fighting with equal intensity, creating the characteristic volatility contradiction that forms the diamond shape. The hidden market dynamics most traders never see. Here's where it gets fascinating. While retail traders are focusing on obvious things like price and volume, legendary traders are reading the market's emotional state through subtle clues that most people ignore completely. They're looking at the gold-silver ratio, not just as a technical indicator, but as a psychological barometer of market sentiment. When the gold-silver ratio was at 105 and compressed to 94, that just wasn't a number change. It was revealing a fundamental shift in investor psychology. Gold represents fear and safety, while silver represents optimism and industrial growth. The ratio compression told a story. Investors were transitioning from pure defensive positioning to cautiously optimistic positioning about economic growth. But here's the hidden dynamic that separates pros from amateurs. They understand that silver's industrial demand creates a psychological feedback loop that most traders completely miss. When Tesla announces increased production, when solar installations surge, when 5G infrastructure expands, these aren't just fundamental catalysts. They're psychological triggers that change how institutions and smart money use silver's future scarcity. The pattern recognition that creates market wizards. The diamond continuation pattern that both Brandt and I identified isn't just a shape on a chart. It's a psychological story written in price action. Most traders see the pattern and think about breakout levels and profit targets. Advanced traders see the pattern and understand the emotional journey that created it. The diamond pattern forms when a market reaches a psychological inflection point where neither bulls nor bears maintain control. The expanding volatility at the beginning of the pattern represents increased emotional intensity as traders become more and more divided. Then the contracting volatility represents exhaustions, both sides getting tired of the fight. What separates legendary traders is their ability to recognize when this psychological exhaustion is about to resolve into explosive directional movement. They're not just looking at the pattern, they're feeling the market's emotional temperature and positioning themselves before the crowd realizes what's happening. The 68% success rate of diamond continuation pattern isn't just a statistical fact, it's a reflection of human psychology. When markets resolve periods of indecision, they tend to continue in the direction of the previous trend because that's the path of least psychological resistance. The breakout comes a psychological release valve for all the pent-up emotional energy. Advanced volume psychology, reading institutional intentions. Here's where it gets really advanced. Legendary traders don't just look at volume. They read volume as a psychological language that reveals institutional intentions. When SLB broke out with 60 plus million shares traded, triple the average, that wasn't just high volume, it was institutions telegraphing their psychological state. Retail traders see high volume and think breakout confirmed. Advanced traders see high volume and ask, what psychological pressure forced institutions to move this much capital at these levels? The answer reveals whether this is smart money positioning for a sustained move or panic buying that will reverse quickly. The psychology behind institutional volume is completely different from retail volume. When institutions move big size, it's because they've done extensive research and they're positioning for moves that may take months or years to fully play out. Retail volume is emotional and short term. Institutional volume is calculated and strategic. Now, before we dive deeper into the psychological traps that destroy most silver traders, I want to share something exclusive with you. Everything I'm teaching you about market psychology and advanced pattern recognition, this is just the tip of the iceberg. On my Substack, I publish my complete trade logs, including the exact position sizes, entry points, and exit strategies I'm using for the SLB position. You'll see my real-time thought process, the specific psychological triggers I'm monitoring, and the mathematical approach I use to size every position. This isn't theoretical, it's my actual money, my actual trades, and my actual result. If you want to see how legendary trading psychology translates into profitable positions, check out the link in the description for exclusive access to my complete trading methodology. The psychological trap that kills 90% of silver trades. Here's a psychological trap that destroys most traders. They approach silver with the same mindset they use for stocks or Forex, but silver operates on a completely different psychological timeline. Silver moves are psychological events, not just price movements. Most traders get into silver expecting quick moves and immediate gratification. Silver psychology is about patience and endurance. The market will test your conviction repeatedly before rewarding you. The traders who survive are the ones who understand that silver's volatility isn't random. It's the market's way of shaking out weak hands and ensuring that only truly committed capital remains. The psychological mistake that kills traders is treating silver's disappointments as surprises instead of features. When Brandt says silver loves to disappoint, he's not complaining. He's describing the market's psychological defense mechanism. Silver disappoints the weak hands and rewards the strong hands. It's not personal, it's just how the market works. The advanced risk management psychology. What truly separates legendary traders is their psychological approach to risk management. They don't just set stop losses, they understand the psychology behind why stop losses work and when they fail. Brandt's mechanical stop at the diamond pattern low isn't just a technical level, it's a psychological anchor that keeps him from making emotional decisions. The advanced psychology of risk management is about understanding that your biggest enemy isn't the market, it's your own psychological need to be right. Most traders move their stops because they can't psychologically accept being wrong. Legendary traders embrace being wrong because they understand that losses are just information, not personal failures. This is why the math-engineered approach to position sizing is so crucial. It removes the psychological pressure from individual trades. When you risk exactly 0.7% of your capital on every trade, no single trade can psychologically destroy you. This emotional freedom is what allows legendary traders to execute their strategies without hesitation. The institutional psychology behind silver's next move. Here's what most traders don't understand. Silver's next major move won't be driven by technical pattern or fundamental analysis. It will be driven by a psychological shift in how institutions think about inflation, industrial demand, and monetary policy. The technical patterns are just the visible symptoms of this deeper psychological change. The supply deficit psychology is already changing how institutions view silver allocation. When supply deficits persist for 5 consecutive years, it creates a psychological scarcity that changes buying behavior. Institutions start thinking about silver not just as a trade, but as a strategic asset that needs to be accumulated. This psychological shift is what creates the sustained bull markets that catch everyone off guard. It's not about individual news events or technical breakouts. It's about a fundamental change how smart money thinks about silver's role in their portfolios. Now that you understand the psychological patterns that separate legendary traders from everyone else, I want to share something that might surprise you about my investment approach. I've been quietly building a position in what I believe is the most misunderstood AI play in the market today. In fact, I just released a comprehensive analysis revealing the 5 biggest mistakes investors are making with ExxonMobil and why this could be the ultimate contrarian AI play. Check out my latest video, 5 big mistakes you're making with ExxonMobil investments. I break down my exact strategy, including how I'm using Peter Brandt's oil price analysis to time my entries and why analyst upgrades are actually a warning sign, not a buy sign. The link is in the description below. Don't miss this opportunity to position yourself ahead of the crowd in the AI energy revolution.